The numbers on the screen right now are telling a story that most of the market is skimming over, but we are going to read every single line. At this exact moment, Cipher Mining Inc. is trading at $15.86, posting a gain of $1.24, which translates to a massive intraday move of 8.48% in the green. When you see a move of nearly 9% in a single trading session, the knee-jerk reaction from the retail crowd is to assume this is just another sympathy play, that perhaps Bitcoin had a good morning and Cipher is just drafting behind it like a cyclist in a peloton. The expectation is that this is a simple leverage play on crypto prices, a high beta asset that you trade when you feel lucky and dump when the digital gold starts to rust. The reality, however, forces us to look at something far more structural and far less correlated to the day-to-day whims of coin prices. What we are witnessing with Cipher mining right now is a repricing of power infrastructure in the United States, disguised as a crypto rally. While the general public looks at the ticker and sees a Bitcoin miner, institutional capital is looking at the order book and seeing a power generation and transmission asset that has effectively cornered a piece of the Texas grid. The disconnect between these two views is where the opportunity lies, and that is why the volume today is telling us that this is not just retail traders on the Robinhood app chasing a green candle, but a deeper accumulation phase by entities that understand the scarcity of gigawatts in a world hungry for artificial intelligence. If you have been watching the flows through Interactive Brokers trading platforms, you might have noticed that the bid support for Cipher has been stepping up consistently, ignoring the minor dips in the broader crypto market. This suggests that the market is beginning to price in the AI pivot that we have been hearing whispers about for months. Just recently, Cipher announced a significant expansion involving a proposed offering of $333 million in senior secured notes. To the uninitiated, taking on debt sounds like a burden, but to a smart investor, this specific tranche of debt is essentially growth fuel. They are raising this capital specifically to build out the Barber Lake facility. This is not debt to pay the lights bill. This is debt to build the engine. The fact that they can raise this kind of capital at 7.125% in this macro environment signals that the credit markets trust their cash flow models, something you rarely see in the volatile world of crypto mining. The sheer magnitude of this move today, up over 8%, creates a tension in the chart. When you compare this to Apple stock, which might move a fraction of a percent on a standard day, the volatility here feels dangerous. But volatility is only danger if you do not understand the source. The source here is a fundamental shift in business model. We are seeing Cipher transition from a pure-play miner into a high-performance computing, or HPC, landlord. They recently signed a massive 10-year agreement with Fluidstack, and here's the detail that most headlines buried. Google is backstopping a significant portion of those lease obligations. Let that sink in. You are looking at a company that trades like a penny stock proxy for crypto, yet it has lease agreements effectively guaranteed by one of the largest tech balance sheets on the planet. This creates a floor on their revenue projections that simply did not exist 6 months ago. This brings us to how you should be thinking about your own portfolio construction. Many people today rely on automated tools like Schwab Intelligent Portfolios to smooth out the bumps in the road, creating a diversified blanket of assets that protects them from risk. That is a perfectly valid strategy for preservation, but for self-investing, specifically for those who use individual brokerage accounts to hunt for alpha, Cipher represents a specific type of asymmetrical bet. You are betting that the market will eventually stop valuing them as a miner and start valuing them as a data center REIT. If that repricing happens, the multiples expand significantly. It's the difference between being valued at 3 times earnings versus 20 times earnings. Let's talk about the NVIDIA correlation. You cannot discuss NVIDIA stock without discussing the power required to run their chips. As NVIDIA continues to ship Blackwell chips and whatever comes next, the bottleneck shifts from silicon to electricity. There is no point in having $1 billion worth of GPUs if you can't plug them in. Cipher Mining sits on that plug. By securing the Barber Lake expansion and integrating with the ERCOT grid in Texas, they are positioning themselves as the gatekeepers of the electron flow that AI needs to survive. This is why you see that strong correlation. When NVIDIA beats earnings, miners like Cipher jump, not just because the tech sector is happy, but because the market realizes that NVIDIA's customers need a place to host those chips. It's fascinating to watch the chat rooms on SoFi Invest or the forums dedicated to Robinhood investments light up on a day like today. You see a lot of excitement about the price action, but very little discussion about the cost of energy per kilowatt hour. Cipher's edge has always been its weighted average cost of power. In the mining game, your revenue is volatile, Bitcoin price, but your costs are fixed, electricity. Cipher has managed to negotiate power purchase agreements that allow them to mine at a discount when the grid is flush with energy and curtail operations when prices spike, effectively selling power back to the grid. This arbitrage capability turns them into a grid stabilizer rather than just a consumer. It's a level of sophistication that you don't typically find in the smaller miners you might stumble across while browsing investing sites. Now, I want to pause for a second and ask you to weigh in on this because the sentiment around miners is so polarized. Comment below how many shares of Cipher Mining you currently hold, or if you're waiting for a pullback to enter. I'm genuinely curious if you were playing this for the Bitcoin halving cycle dynamics, or if you're holding it as an AI infrastructure play. Let's dig deeper into the mechanics of this rally. The volume we are seeing today is not just accumulation, it's a squeeze. Short interest in miners has been high because many hedge funds use them to hedge their long Bitcoin exposure. As Cipher moves up 8%, those shorts are forced to cover, creating a feedback loop that drives the price higher. If you're managing your Fidelity IRAs or looking at Fidelity mutual funds, you might not see this granular level of price action. But in a Fidelity brokerage account where you can see the level 2 data, the buy walls are stepping up. The sellers are exhausted. They have thrown everything they have at this stock to keep it under $15, and today that dam broke. We need to contextualize this against the broader sector. If you look at Tesla stock, it trades on the promise of future autonomy and energy storage. Cipher is trading on the immediate reality of energy consumption. The market is beginning to understand that compute is a commodity, just like oil or gold. And just like oil needs pipelines, compute needs data centers with massive power connections. Cipher's Odessa facility and the new Black Pearl site are essentially oil fields of the digital age. The oil they produce is hash rate, and the pipeline they own is the substation connection. This infrastructure moat is difficult to replicate. You can't just walk into West Texas and plug in 300 megawatts tomorrow. The regulatory approval, the grid studies, the construction, it takes years. Cipher has already done the heavy lifting. This is why the Robinhood cash management crowd might be missing the forest for the trees. They see the daily percentage gain and think, quick flip. But the Fidelity wealth management perspective, the long-term view, sees a company that is slowly decoupling from Bitcoin. In 2 years, it is entirely possible that Cipher's revenue mix will be 50% Bitcoin mining and 50% high-performance computing hosting for AI clients. If that happens, the volatility should dampen and the valuation premium should increase. You would be moving from a high-risk commodity producer to a stable, cash-flow positive infrastructure landlord. Let's look at the risks, because no analysis is honest without them. The primary risk remains the price of Bitcoin in the short term. If Bitcoin crashes to $40,000 tomorrow, Cipher will drop. There's no escaping that gravity yet. Furthermore, the transition to HPC is expensive. That is why they are raising $333 million. Converting a mining site, which can run hot and dirty, to an AI data center, which needs pristine cooling and dust control, is a capital-intensive process. This execution risk is real. If they fumble the construction at Barber Lake, or if the Fluidstack deal hits a snag, the market will punish them. This is not a set-it-and-forget-it holding, like you might find in Schwab Intelligent portfolios. This requires active monitoring. But the presence of the Google backstop changes the calculus significantly. It suggests that the due diligence has been done by parties with far more resources than the average retail investor. When a trillion-dollar company agrees to guarantee a lease, they have inspected the blueprints, they have analyzed the power contracts, and they are satisfied. For an investor using SoFi Active Investing or similar platforms, this is a signal that you can draft behind the smart money. You don't need to be an engineer to understand that if Google is involved, the power connection is real. The broader market context is also favorable. We are in an environment where the Federal Reserve is navigating a soft landing, and risk assets are back in vogue. But unlike the speculative bubbles of 2021, the money is chasing real earnings and real assets. Cipher's recent earnings reports have shown that they can remain operationally cash flow positive, even when mining economics get tough. They have survived the crypto winter and emerged with a cleaner balance sheet than many competitors who over-leveraged and went bankrupt. This survivorship bias is a good thing. The herd has been culled, and the strong are eating the market share of the weak. If you are using the Robinhood crypto feature, you know that buying Bitcoin directly is the purest play, but